Let's talk about accounting. And I know what you might be thinking. Spreadsheets, math, maybe a total snooze fest. But what if I told you accounting is actually one of the most powerful forms of storytelling there is? We're going to look at it for what it truly is, the language of business.
So picture this. You've launched a business. You've got a great idea. You're pouring your heart and soul into it. People are even paying you. But how do you actually know if it's working? Is it just a gut feeling? The amount of cash in your bank account today? To really measure success, you need a system, right? A common language that you, your investors, and even the bank can all look at and say, okay, I get it. I trust this.
Well, that system, that universal language, that's accounting. It's the framework that takes all your hard work, all those sales and expenses, and translates them into a clear, understandable story about the health of your business. It's how everyone, and I mean everyone, agrees on how to keep score.
And at its heart, that's really all it is. Seriously, forget about complicated calculus. Think of accounting as a communication tool. It's designed to take every single economic event, every dollar that comes in, every dollar that goes out, and organize it into a report, a story that people can actually read and understand.
You've probably heard this quote before, right? It's a classic for a reason, because it is absolutely true. If you want to understand what's really going on inside any company, from the corner cafe to a giant like Google, you've got to be able to speak the language. Now think about it. For any language to work, it has to have rules. We can't just make up words and sentence structures on the fly. It would be chaos. In accounting, that rulebook is called GAAP, or Generally Accepted Accounting Principles. This is the grammar. It's what ensures that everyone is telling their financial story using the same structure, so we can actually compare one company to another fairly. And who's reading this story? Well, just about everybody. You've got your internal users, the managers and employees inside the company. They're asking questions like, are we staying on budget? Or, can the company actually afford to give us raises? Then you have the external users, investors, banks, even the government. They're asking the big picture questions. Should I invest my money in this? Or if I lend them money, can they pay it back? Accounting has to provide trustworthy answers for all of them. And this brings us to what might be the most important point of all. If this language is being used to make huge, multi-million-dollar decisions, then it has to be truthful. Because if the storyteller lies, if the numbers are fake, the entire system of trust just breaks down, and the fallout can be absolutely catastrophic. And believe me, this isn't some textbook theory. This really happens. Enron wrote a complete work of fiction about its success. When the truth finally came out, the company imploded, and $60 billion of value vanished into thin air. At Wells Fargo, a culture of unethical behavior led to massive fines, and the CEO getting banned from the banking industry for life. This shows you that ethics aren't some fluffy, nice-to-have add-on. They are the bedrock. They're everything. So, if accounting is a language with grammar rules, what does a basic sentence look like? What's the C-spot run of the financial world? Well, believe it or not, the entire language is built on one single, incredibly elegant equation. This is the golden rule. And there it is. Assets equals liabilities plus owner's equity. I know it looks deceptively simple, but this one little formula is the core of everything. It's like the E equals MC squared of business. Every single transaction, from buying a pencil to buying a skyscraper, must keep this equation in perfect balance. It is the fundamental law of accounting physics, no exceptions. Okay, so let's break that down real quick. On one side, you have assets. This is simply all the valuable stuff the business owns. We're talking about cash, land, equipment, the supplies in the back room. It's all the resources the company has at its disposal. The other side of the equation shows who has a claim on all that stuff. First up, you've got liabilities. In plain English, these are the company's debts. It's what the business owes to outsiders, like a loan from a bank or money owed to a supplier for inventory. And the final piece of the puzzle is owner's equity. This is the owner's claim to the assets. The best way to think about it is like the equity in your house. Let's say your home is worth $300,000 and you have a $200,000 mortgage. The $100,000 that's left over for you, that's your equity. It's the same exact concept in a business. So you can think of it like this. All the company's stuff, its assets, has two different types of claims against it. The claims from the outsiders you owe money to, those are the liabilities. And the claim from the insider, the owner, that's the owner's equity. And together, the value of those two claims must always equal the value of the stuff. Okay,
So we've got our basic sentence structure, that equation. But how do we actually write the story of the business? Well, it gets written one event at a time through something accountants call transactions. Every time business is done and money changes hands, a new sentence gets written in the story, always keeping that core equation in balance.
Let's make this real. Let's start a business called Net Solutions. On day one, before a single thing has happened, the financial story is just a blank page. 0 assets, 0 liabilities, and 0 owner's equity. And hey, look at that. The equation balances perfectly. 0 equals 0 plus 0.
Now, the first event. The owner invests $25,000 of their own money. So what happens? On the asset side, the company's cash goes up by 25 grand. But wait, now the equation is out of whack. To fix it, something on the other side has to go up too. In this case, it's the owner's equity, their personal stake in the company. It also goes up by 25 grand. And just like that, we're perfectly balanced again. See how that works?
Let's do one more. Net Solutions does some work for a client and earns $7,500 in cash. Awesome. So the company's cash, an asset, increases. And on the other side of the equation, that new revenue increases the owner's claim on the business. So owner's equity also goes up by that same amount. And, you guessed it, the equation stays perfectly balanced. Every single transaction works exactly like this.
Okay, so a real business has thousands, maybe millions of these transactions. You're not going to sit there and read them one by one. It would be impossible. You need the summary, the highlight reel. And that's exactly what financial statements are. They're the chapters in the book of your business. And what's really cool is how these chapters all connect to tell one continuous story. You start with the income statement, which tells you if you made a profit. Then, that final profit number, your net income, flows directly into the next chapter, the statement of owner's equity. And the final number from that statement flows right into the last chapter, the balance sheet, which proves that the whole story still adds up and the main equation is in balance. It's a really elegant system. So if you think of it like a story, the income statement is the action plot. This is where all the drama happens. It's tracking all the revenues coming in versus all the expenses going out over a certain period, like a month or a year. And that final bottom line, the net income, tells you if the hero of our story, the business, won or lost that chapter. The balance sheet, on the other hand, isn't a movie. It's a photograph, a snapshot. It freezes time on one specific day, say midnight on December 31st, and gives you a perfect picture of the characters and the setting. It tells you exactly what the business owns and exactly what it owes at that single moment in time. So, the chapters are written, the story is complete. But, is it a good story? Is the business, our main character, actually healthy and strong? Well, to figure that out, you have to put on your critic hat and start analyzing what you've read. And you don't need to be a Wall Street wizard to do this. There are simple but powerful tools, like financial ratios. Take this one, for instance. It sounds a little technical, but all it really does is answer one critical question. Is this company running on borrowed money, or is it funded by the owner's own investment? Here's how a simple ratio can tell a huge story. Let's compare two companies you know, Twitter and Google's parent, Alphabet. Twitter's ratio is 0.92. Which means for every dollar of owner's equity, there's about 92 cents of debt. Now look at Alphabet. Its ratio is less than half that. Just by looking at that one number, a potential lender can see that Alphabet relies way less on debt, which usually means it's a much safer bet. So in the end, when you strip it all away, accounting isn't really about math. It's the framework for telling the true story of a business, a story of risk, of strategy, and of success. And that really leaves just one final question for you. Every number tells a story. What story are your finances telling?